Hello there, students of economics. It's my pleasure to welcome you to yet another teaching resource in economics. As you know, we have begun with the topic national income accounting and related aggregates. In the previous video, we learned 5 terms in national income accounting. They are national income, GDP, private income, and personal disposable income. We also learned about the circular flow of national income. Today, we will dwell on the methods of calculating national income. Well, there are 3 methods of calculating national income. They are the value added method, the income method, and the expenditure method. We will be studying the following 2 methods of calculating national income in this teaching module. 1. The value added method, also known as product method or output method. And second, the income method, also known as distributed share method and factor payment method. We will also be learning about the components of factor incomes. Let us begin with the product method or value-added method of calculating national income. Well, it is that method which measures national income in terms of value added by each producing enterprise in the primary sector, secondary sector, and tertiary sector of the economy during an accounting year. In order to avoid the problem of double counting, the reason we take the value added of each producing enterprise and not the value of the final output is because we want to avoid the problem of double counting. So here we see that gross value added, which is taken in order to find national income, is the sum total of value added in the primary sector, the value added in the secondary sector, and the value added in the tertiary sector. Well, what is value added? Value added is the difference between the value of output produced and the value of intermediate consumption, or in other words, the value of the inputs used in the process of production. Let me explain the concept of value added with the help of an example. Consider this piece of furniture. The value of this output that I have produced is, say, rupees 10,000. In order to produce this piece of furniture, I had to buy planks from the sawmill or the sawmiller. And the value of this intermediate consumption or the value of the input that I used to produce the chair was, say, rupees 6,000. Well, at this particular level, what would be value added? What I have to do is I have to subtract the value of intermediate consumption from the value of output, and that will give me the value added, that is rupees 4,000. 10,000 minus 6,000. Let's take another example with more levels. So I've put it in a form of a table in tabular form. So we have the value of output, the value of intermediate consumption, and in the last column, the value added. You have 3 levels here. The woodcutter, who cuts the wood from the forest, the sawmiller, who buys the logs of wood from the woodcutter, and the carpenter, who buys the planks from the sawmiller. Well, the value of output of the woodcutter is 4,000, and the value of output of the sawmiller is 6,000. So also the value of the final output of the carpenter is 10,000. Now for the woodcutter, he just had to go to the forest or his property and cut some trees down. And he assigned a value of 4,000. So he has added value to his output. He sells this wood to the sawmiller for a sum of 4,000. Well, the sawmiller makes the wood or cuts the wood into planks, and he sells his output for 6,000. As you can see, he has added a value of 2,000 over the 4,000 that he spent to buy the wood from the woodcutter. And how did we get 2,000? 6,000 minus 4,000 gives us 2,000, which is the value added. Now the carpenter buys the planks of wood from the sawmiller for a sum of 6,000. So for the carpenter, the planks of wood cost 6,000, and so that becomes the value of intermediate consumption for the carpenter. He assigns a value of his final piece of production as 10,000. So the value of his output is 10,000. The value of his intermediate consumption is 6,000. So 10,000 minus 6,000 is 4,000. As you can see here, at every level of production, there is some value added. The sum total of all the value added at every level of production in this particular sector is the gross value added, which is 10,000. And this gives us the correct picture of the value of goods produced in that particular sector. Now, why is value added considered and not the value of the output? Because it results in the problem of double counting. Well, what is double counting? Double counting means measuring the value of a good more than once. While calculating national income, if care is not taken to avoid the problem of double counting, it will lead to overestimation of the national income. So we will get a higher figure of the national income if we consider only the value of the final output. For example, adding the value of the ingredients of the bread to the value of the bread will result in counting the value of the ingredients twice. Why? Because the value of bread already includes the value of the ingredients. Let us try to understand the problem of double counting by considering the table we took earlier. Now we need to understand why we consider the value added and not the value of output while calculating national income according to the value added or product method. Let us see why. As you can see, the value of output of the woodcutter is 4,000. The value of the output of the sawmiller is 6,000, which includes the 4,000 paid to the woodcutter. We can see that the value added by the sawmiller is 2,000. The value added by the woodcutter is 4,000 because he doesn't have to pay anyone any value of intermediate consumption. However, the sawmiller has to pay 4,000 to the woodcutter for the logs of wood. The actual contribution of the sawmiller is not a total sum of 6,000 but only rupees 2,000. The 4,000 is the cost price of the logs of wood that he paid to the woodcutter. The carpenter purchases the planks of wood for a price of 6,000 from the sawmiller. And for the work that he does to produce the piece of furniture, he assigns a value of 4,000. He adds a value of 4,000. He takes this value added to the output that he produces and adds it to his cost price that he paid to the sawmiller for purchasing the planks of wood, and he assigns a total price of rupees 10,000 to his output. We cannot take the value of output and total it up and say that this is the value of the product that is produced or at all levels. Why? Simply because it gives us an exaggerated figure of 20,000. In this 20,000, the value of the woodcutter's output is counted more than once. First time it is counted when counting the value of the output of the woodcutter. The second time it is counted while counting 6,000, which includes 4,000. The third time the value of the woodcutter is counted is here within this 10,000 assigned by the carpenter, because the carpenter includes the value 6,000 paid to the sawmiller, which in turn includes the value 4,000 paid to the woodcutter. So therefore, we do not consider the value of output. However, we consider the total value added, which is 10,000, because this 10,000 gives us a correct picture of the contribution of all the stakeholders in this particular producing sector. The contribution of the woodcutter is rupees 4,000. The contribution of the sawmiller is rupees 2,000. The contribution of the carpenter is 4,000. So when we add 4,000 to 2,000 and to the 4,000 value added of the carpenter, we get the correct value of what has really been produced at all the different levels in this particular sector. Going on to the next method, which is the income method, also known as distributed share method and the factor payment method. In this method, the factor incomes generated within the domestic territory of a country during an accounting year are added up, and to this, the net factor income from abroad is added to get the national income of the country. The income method of calculating national income. In this method, we add the factor incomes in the domestic territory of the country to the net factor income from abroad, and this gives us the national income figure. Note that the net factor income from abroad is the difference between factor incomes earned by our residents abroad and factor incomes earned by non-residents in the domestic country. Now moving on to the classification of factor incomes that we were talking about in the previous slide. Well, factor incomes are divided into three categories. The first being compensation to employees, the second operating surplus, and the third mixed income of the self-employed. The first component of factor incomes is compensation to employees. What does it include? It includes wages and salaries in cash and in kind, employers' contribution to social security schemes, and pension on retirement. Examples of employers' contribution to social security schemes could be the government provident fund or the public provident fund. The second component of factor incomes is what we call as operating surplus. What is operating surplus? It refers to income from property and entrepreneurship. We know that income from property would be rent and interest, and income from entrepreneurship will be profit. So therefore, operating surplus includes rent, interest, and profit. Now, profit is further divided into three. The first, corporate profit tax, which is the part of profit which is paid to the government. The second, dividends. This is that part of the profit which is distributed to the shareholders. So it is also called as distributed profit. The third, undistributed profit. This is that part of profit which is retained by firms for future use, particularly to meet some contingent expenses or ongoing expenses. They are also called as corporate savings. So please remember, operating surplus refers to the income from property and entrepreneurship. The third component of factor incomes is mixed income. What is mixed income? Mixed income refers to the incomes of self-employed persons using their own labor, land, capital, and entrepreneurship to produce goods and services. So therefore, these incomes are a mixture of wages, rent, interest, and profit. Since the self-employed person owns all the factors of production, that is labor, land, capital, and entrepreneurship. He retains all the incomes. For example, for his labor, he gets wages. For land, he gets rent. For capital, he gets interest. And for his entrepreneurship, he earns profit. So his income is of mixed nature, which includes wages, rent, interest, and profit. Let us now sum up the factor incomes with the help of a chart. The first component being compensation to employees, which includes wages and salaries in cash and kind, employers' contribution to social security schemes, retirement pension. The second component is operating surplus, which is again divided into dividends, corporate profit tax, and undistributed profits. The third component is mixed income of self-employed, which includes wages or salaries, rent, interest, and profit. In this teaching resource, we have covered the following: the value-added method of calculating national income, the income method of calculating national income, and the components of factor income. In the next teaching resource, we will learn about the third method of calculating national income, which is expenditure method. Thank you, students, for giving me a listening ear. As always, I encourage you to watch the video again for a better understanding of all the concepts that we covered here. These are very important concepts in national income accounting, and you need to know them thoroughly. Thank you.